go. Timing is everything. Hold on. Show you a little something. There we go. Very nice. Okay, how you doing? This is 0 Days to Expiration. This is Season 2, Episode 13 of the Final Hour Show. I think that's what we'll continue to call it. It is the final hour, although now it is the final half hour. I'm a little bit behind because I was busy conducting interviews with new members of the service. So that's right. Even trial members, I conduct an interview with every single trial member. And the purpose of that is to get them up to speed as quickly as possible so that there's no wasted time. They can get right to the meat of the service and be productive right away. And you want to be productive right away because when you start seeing what's happening, you want to get involved in the action. Now, let me just be clear that this is not an alert service. So whether they get involved in the trades that are going on or not, that's not really the point. The point is getting them engaged in the process. Engaged in the process. Now, this episode is about something that I've noticed. Now, up until about 5 months ago, our standard trade was almost exclusively a single out-of-the-money symmetrical butterfly. And that has served us very well. It's done very well. In tough markets like we have right now, on average, it's producing anywhere from a 3 to a 7% return per month. Remarkable. In markets like we had back in 2021, where the market was just going straight up, it was returning something closer to 15 to 25% per month. Mind-blowing. And that's all with just under a 4% drawdown, max drawdown. This year, the max drawdown has been about 3.25%. So it's proportional to how much we make per month. But anyways, up until that point in time, about 4 or 5 months ago, we were playing that single butterfly and finally realized that there was a better way to play a butterfly in this kind of market, a bear market with bear market rallies like we're experiencing now, and what may continue for quite some time, although I have some things to say about that. The thing that I noticed, and I'm very, very careful to look at my stats, the distribution of returns that we have, where things end up in the course of a day, everything that's involved with placing the trade, the risk to reward, the width of the fly, the amount of volatility, how fast the premium was growing, all of that stuff we take very close note of because we want to be able to place trades as efficiently as possible and then manage them as efficiently as possible. Now, one thing that I prided myself on the single butterfly, the single out-of-the-money symmetrical butterfly, was the amount of times and the knowledge of when trades were likely to pin or how often they would pin. Not necessarily, we didn't really know when. We just knew that if we put ourselves into a certain position, took a trade with a certain risk to reward, there was going to be a percentage of the time that we would actually pin a trade. Now, what does pinning a trade mean in the context that we're talking about? Pinning a trade in our context means that we're going to go all the way to expiration or very close to expiration, and price is going to be somewhere very close to the max potential profit of that strategy. So we're putting on butterflies, and the max potential profit is where the two short strikes are, where the butterfly meets like this. And if you can place it in such a way that the price at the end of the day ends up near there, we call that a pin trade. Of course, if it hits it right on it, then you get the maximum profit. That happens very rarely to get it right on it, although I've come within a couple of cents. But typically we call a pin trade, and when we're anywhere about, 5% plus or minus the total width of the fly. So just a small area. And if we get in that area, we call that a pin. And that's where you're going to achieve something like 90% of the potential value of that butterfly. And that can be significant considering that we only take asymmetric positions. The butterflies that we put on are typically a 1 to 9 risk to reward. In other words, the debit is 1/10 the size of the total of the width of 1/2 width of the fly, because we look at width as being the width of each spread that the fly is comprised of. That comes out to approximately a 1 to 9 risk to reward ratio. So if we put on let's say that the fly is a 30 wide fly, very typical. That means that the maximum potential profit is the width of the fly minus the debit. So if we put on a fly that has 1/10 of the debit versus the width, and it's a 30 wide, that means that fly 30 wide has a maximum potential of $3,000 because it's 100 times 30 minus the debit, which is 1/10 of that, or $300. So 3,000 minus 300 would be $2,700. All right. So that fly would have the max potential of making $2,700. Now, like I said, we get within 5% either way, and we get about 90% of that. That's a pin trade. So in that case, 90% would be, I don't know, $2,430 or something like that. Let's say that $2,400. So about a certain number of times, and at least in the old way, we would hit that pin trade about 10 or 15% of the time. 10 or 15% of our winners, not the total time, because sometimes we wouldn't have a winner at all. Price would go the other way. And then other times it would settle on that fly, and about 10 to 15% of the total time, or about 7% of the time, 5 to 7% of the time, we would hit a pin. That's pretty good. So that means like 1 out of every 10 to 12 trades, we would hit a maximum profit. Now, there were a number of times where it didn't get exactly in the middle, but still made substantial profit, somewhere between 0 and that max. And those could be huge profits as well, up to $2,400. So that's an example. Now, that's pretty remarkable. Now, when you have one fly on, about, I would say 70% of the trades are going to be relatively small. 75% of the trades. And instead of making what that would be, that return would be, let's see, I'll tell you what that return would be. That would be 2,400. That would be an 800% return. Now, most of our trades are around 125% return on that, in that order, 75% of them. And then in between there, about 20% of the trades are somewhere between 125% and 800%. So there's like a range. And what that would produce is this really nice right skewed distribution of returns, very small drawdown, great risk to reward, great or very low volatility on your equity curve. And it would produce an equity curve that was like a stair stepper. It would go sideways, then up, sideways, then up, sideways, then up. Never really down, just like stair step. And produce that prototypical skewed long tail return distribution, which is like the dream of what every professional trader wants in their return distribution. Now, most retail traders, they trade high probability strategies, which produce exactly the opposite, a left skewed, where the long tail is on the losing side, and then the small winners are the little bump in the middle there, the median trade. And consequently, those are generally strategies that lose. That's really the hallmark of being a retail trader, especially day traders. 98% of them lose. That's undeniable. That's what happens. So what we're doing is we're trading like a professional and getting really good results. We don't have the same win rate as the retail trader. As a matter of fact, our win rate is much lower than theirs, but our returns are orders of magnitude greater. So that's all well and good. That's our classic single out of the money symmetrical butterfly using asymmetric risk to reward. It's a fantastic strategy, super easy to trade. Got to get your mind around the whole idea first of all, especially if you're used to these high probability trades, you won't understand it. But in any event, that's our old way. Now, in this particular market, the single butterfly doesn't work really well. So we have to do something a little bit different. So instead, we take a more, I guess you could call it, instead of a directional approach, a more market neutral approach by putting on 2 out of the money butterflies on either side of the market, a put at the lower end, a call at the other end. So I wanted to say a Paul butterfly, but a put butterfly below the market and a call butterfly above the market. Now you would look at that and you would say, how often then do you pin trades there, Ernie? It must be like double, right? And here's the interesting thing. No, it's not double. It's actually way more than double, close to triple. But how can that be if you're only putting on an extra butterfly? The reason is that all of those times that we miss trades and it goes the other way, price could just sort of end up hanging out in the middle or go towards the other end of the spectrum. And as it turns out, that happens quite frequently. Us trying to choose a direction, we're not always right. What makes the strategy really worthwhile is the fact that we can get a lot of these small wins and these medium-sized wins and the occasional big win. When we put on both butterflies, our chances of actually getting into that golden area, that pin trade area, actually goes up by almost 3 times. And that's really remarkable. So now it's creating a different type of distribution return. The new type of distribution of returns is still right skewed. So we still get a bunch of small wins, small losses, but we actually get a fewer number of those. And then we get more medium size and more long tail winners. And we create a long tail that has a particular characteristic because now we're getting more of them. That tail gets fatter, and that creates what we call a fat tail return. Now, that is the ultimate in what a professional trader wants, or any trader wants. They want fat tail winners. That means that we're getting a lot of big chunky wins and many more pin trades, which are humongous wins, anywhere from 300, 500, 800, 1200% return. So that has been the result of going to the Batman trade as opposed to the other way around, the classic, what we call the classic butterfly. You might want to think then maybe you should do that in the trending markets too. Try the Batman trade. But the problem with that is that we have a little bit more surety about which way the market's going in a trending market. It's usually going in the direction of the trend. Although we do occasionally pick against the trend moves, but those are typically pullbacks, and they're more reliable too. They pull back, so we can play the pullback, and then they go the other way, and we can play the continuation as well. So the single fly is still good in a bullish trending market, but the Batman, and it produces a fantastic equity curve in that case, really fat returns, because we hit, in that kind of a market, we hit these pin trades very frequently in a trending market. But trying to take that same single fly and put it into a bear market, it doesn't do it so much. However, by adjusting that and putting on 2 flies and essentially increasing the risk by 2 times, I'll talk about that in a sec. You're doing that, and so you're taking a little bit away from each one of the flies, the amount that you're putting at risk. However, in our strategy, what we do is instead of allowing it to go to full risk and take the full loss, we only allow it in the worst case scenario to go halfway or 50% of the risk. And that's because there's a much better chance that it's going to end up with a small win either above or below the market, and a much better chance potentially of even getting a medium size or a pin trade. So that's why we don't really sweat that. And so what ends up happening is that the number of winners and losers that we have are still small in terms of their magnitude, but there's fewer of them. And so that now has been distributed to medium-sized winners and pin trades. So it's like a pimple popper. We took the pimple of the small wins and losses and squished it, and it had to go somewhere. It didn't go towards the losers. It went towards the winners. And so that creates the fat tail. Hopefully that was, how should I say, that was illustrative enough that you understood that. And a lot of people may not even understand what the hell I'm talking about. So Norm says, you were supposed to call me last week. I'm still waiting. I don't call anybody, Norm. They call me. Anyways, I'm not sure exactly. I'll call you, Norm, and we'll find out what your beef is. But I think that you didn't sign up and get onto the Discord and notify me that you were there. And then so we've been missing each other. So we'll fix that up. So anyways, that is how the pin trade has been improved dramatically by putting on the Batman. This is a live show, so we deal with all comers. I don't know if is there anybody else there out in the chat? If you're out there, say hello. All right, it is getting close to expiration, so we have to check out whether or not we're getting to another pin trade. And so we'll go to the charts. So this is the trade that I put on. Now, let me just say something about this trade here. You'll see that it's not a symmetrical trade. That was my problem. I made that mistake earlier today. I put on that trade. I put on the two Batman trades. So there was the bearish one like this, and then the bullish one. And you'll see that the bearish one, of course, they were centered on the market when I put them on, but now that the market has gone up, it's now starting to be centered on the bullish trade. So you can see that when I put on the bearish trade, the put trade, it cost me $3.20. These are 30 wide trades. And so that's 1/10 of the width of that trade. When I put on the bullish trade, the bullish butterfly, the call fly, I put it on, I said, I can get it at $2.75. So that was a little bit, well, $3.25 is a little over 1 to 9, and $2.75 is a little under 1 to 9, and they averaged out to 1 to 9 each. And so I put that on, but I didn't recognize that, oh my God, I made that back leg 40 wide instead of 30 wide. And so that presented just a little bit of a risk, not that much. And I was a little bit concerned about it. And during the day, I decided to get out of the trade a little bit early because price started to go over here and the profit line was being dragged down by this extra width. And so I got out. So I didn't stay in for the pin trade. However, I paid $2.75 for it. And what did I make? I made $15.75. So I made $13 on that trade. So still not a bad deal. Now, so I got out early because it was threatening to go to this side, to the risk side. And I wasn't willing to change this once I got into it because the cost of getting in and out of a E-mini trade is pretty expensive. Now, I know that other members of the service have been in this trade, and they may still be in this trade. That's what we need to find out. Where the hell are they? Let's see. Let's go to the Discord and say, hey, where are you? Everyone, I am live right now. Come to the chat before the market closes. Yeah, that'll get them there. All right. This trade looks like, see, right now, this trade is worth, I got out, it was worth about, I don't know, $650. And this trade right now is worth $820. if it can get right to the center strike, it's actually worth more than that because I took off this fly. So this trade right now is actually worth $940. And if it gets to the center strike, it'll be worth about $1,400. Just about 1,400, right in there. So pretty close. Now, when I say 5% on either side, if the width is 60, then I guess that would be about 4 points on either side, or an 8-point total. So I would say like between here and, let's see if we can get this other, let's get this other one here at 40, 50, right? So between here and here, I would consider that a pin trade. And we're just on the edge of it. I mean, this is pretty close. And that will give us about 90% of the total value of that. Where we are right now, it's probably going to give us about 80% of the total value, which is still good. Don't get me wrong. That's fantastic. Question is, will we move into this area? Will the market cooperate while I'm doing a live stream talking about pin trades? Will we get pinned? All right. Now, take what I said very seriously earlier about the percentage of pin trades that we used to get with the single fly. And now we're getting those at a much higher rate. And I randomly chose a day to talk about this particular concept. And here we are, almost right at a pin trade. All right, so we missed it by a couple points. But still, that looks like that trade made about $900. So that trade cost $275. So 900, that would be $18 because it's double. The E-mini is a 50-cent multiplier, or 50 multiplier. That would be, let's see, 275 divided by 2 equals 137.50. So 900 divided by 137.50. That would have been about a 650% return today. Now, I got out of it, I think, at a good time, almost an hour ago, and I didn't make that much worse than that. So overall, I think getting out when I did was probably a good move. All right, there you go. There's the kind of trades that we're doing. I would say, like I said, I think now our pin trades, or our really fat, meaty trades that are contributing to our fat tail returns, seems to have doubled, more than doubled, than what we did with the single fly. And the risk, or the win rate, has also increased, while the risk has decreased. Now, one could say that the risk has increased theoretically to double that, but in practicality, the chances of us hitting a risky trade are far less now. So there you go. That's about all I have to say. I got to go call Norm. And take care. Let's see. Let's get back to the big head. Thank you. Peace to you all. And we'll see you next time.